Avoid the traps. Many stocks have an alluring appeal to them. A low PE ratio. Maybe they beat earnings estimates regularly. Or they have the ultimate siren song, a high yield dividend. It seems so nice, a 5, 6, or even 8% yield on your investment automatically without even the need for capital appreciation. Sometimes you can even talk yourself out of the need for growth for that sweet dividend yield. But as enticing as these stocks are, it is one of a few red flags for the dreaded dividend traps. Welcome to the Quality Investor. Dividend investing is an important part of overall investing. While my channel focuses on quality businesses first and foremost, a secondary aspect of the Quality Investor is dividends. Ultimately, one of my goals is to build a large portfolio of passive dividend income, the truest form of passive income there is. However, it is important to focus on quality first when constructing a portfolio, because if the quality is not there, all those secondary factors, like dividends, have the potential to dwindle, and that is unreliable, the opposite of predictable. And predictability is one of the traits of quality. So on today's video, we are discussing the dreaded dividend traps. What is a dividend trap? How can we spot them? We are going to answer these questions so that we can build the best possible portfolio to achieve our own goals. What is a dividend trap? First off, they are attractive. Perhaps you have a screener set up for high yielding dividends and you see some of those juicy 6 to 8% yields. That's way better than a high yield savings account and even money market funds. And there's the potential for capital gains. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. But a high yield is often the first red flag. So we can define a dividend trap as a stock whose price and dividend decline steadily over time. The yield is high because the share price is low. Yield is dividend per share over price. Therefore, the lower denominator or price, the higher the yield or dividend as a percentage of price. The next red flag is recent price depreciation. A declining stock price can mean a number of things. It could be out of favor by the market. Maybe a bad couple of quarters of earnings scared the market. Perhaps some negative event hit the business and the market is panic selling. Here, it is important to parse the financial data. Are earnings down due to industry cyclicality? Or is this a sustained downward trend because the business is declining in sales and market share? Has the business made some poor acquisitions that are burning up operating cash flows? A lower stock price not only makes the dividend yield look more attractive, it makes the PE ratio look lower as well. Many investors consider a low PE ratio as a stock that could be on sale. Usually though, it is the mark of an average or declining business. Rising or high debt levels is another sign of a dividend trap. Increasing debt means increasing interest payments, and interest payments eat away at net income. It is an obligation that a business must pay, and it ultimately detracts away from the cash that is available to investors, free cash flow. Not only that, but debt must be paid off. If debt loads become unnecessarily high, a business will have to prioritize using cash flow to service debt instead of returning that capital to investors in the form of dividends. This could lead to the worst possible outcome for dividend investors, a dividend cut. And this leads to the final red flag on our list, high payout ratios. A payout ratio is traditionally a percentage of earnings that the company pays out as a dividend, but I prefer a narrower definition. I like to look at what percent of free cash flow a business pays out as a dividend. This is because a business can only pay its dividend from cash available to its owners, which is free cash flow. Once that free cash flow payout ratio creeps up above 75-80%, it will be very difficult for a business to sustain that dividend payment over time. A business must throw off lots of excess cash to not only pay out its dividend, but to increase that dividend over time. Declining free cash flow is a symptom of a declining business. So let's take a look at some businesses that fit each one or more of these red flags. That way, we can avoid these dividend traps and invest our hard-earned money wisely. The first company on our list today is Whirlpool, ticker WHPW. are. They distribute all sorts of appliances that you'll find around the home, refrigerators, washer and dryers, so on. So a business that makes everyday life a little bit easier with the amount of household labor. And as you can see here, we're going to look at our first red flag, a high dividend yield. Since fiscal year of 2021, that yield has popped to 5.7% at the end of their fiscal year 2023. Not only that, you can see that that dividend growth has slowed down a little bit here. And we can also see that that free cash flow payout percentage has also spiked up in fiscal year 2023. And we can see here why. Their free cash flow has seemed to have fallen off a cliff here. So while their dividend has steadily grown in the past 10 years or so, the free cash flow has not kept up recently. So to me, looking at these dividend metrics right now, this is right here signals a company that could be a dividend trap. Looking into their numbers a little bit further, their share price right now is $102.41. We can see that's down almost 16% year to date. And their current dividend yield is at 6.84%. So that yield has gone up even more. Another red flag to point out, look at their total debt. That has risen while their cash has also fallen. So this is a company that has seen rising debt levels. Their free cash flow is falling. Their dividend yield is rising. You can see that their sales have pretty much been flat in the last 10 years. The earnings are all over the place. To me, Whirlpool is a great example of a business that is a dividend trap. While their dividend has technically not been cut, it is flat in fiscal year 23 versus fiscal year 2022. But if this trend continues, declining free cash flow, flat sales, rising debt levels, they're going to have to make some tough decisions, especially if they need to start prioritizing paying down that debt over distributing dividends to investors. And that, of course, means a potential dividend cut. The next example I want to show is Verizon Communications, ticker VZ. Verizon seems to be talked about a lot in the dividend community on social media, and rightfully so. They have that very attractive yield, 7% at their last fiscal year. But as we can see here, that is a rising dividend yield. And their free cash flow payout has been kind of high historically, but an 86% free cash flow payout ratio, that is definitely a cause for worry. And another aspect to consider is that dividend growth percent, the year-over-year growth percent, has been slowing down a lot. It's slowing down because they want to keep paying that dividend. They've had 17 consecutive years of dividend growth now. They want to keep increasing that dividend for investors, but they know that it's getting tougher to afford paying out an increasing dividend year after year. Another problem with slowing dividend growth is, let's be honest, 2% dividend growth year over year, that does not keep pace with the current inflation environment that we're in. So even though that dividend is growing, investors that are relying on Verizon for dividend income, they're actually losing money because their dividend is simply not growing at the pace that inflation is going. You can see their free cash flow just simply has not risen along with that dividend. And if we look at their overall financials here, you see that dividend yield has come down to about 6.1% as of right now. And that's due to the fact that the share price has increased this year to date. It's up almost 18%. It's currently sitting at $44.33. But the rest of their financials, in my view, do not look good. They have massive amounts of debt. And of course, they are a very, very capital intensive business due to the type of business they operate. Telecommunications requires a lot of capital in order to set up the infrastructure for a nationwide network. But we can see that they just don't generate the type of operating cash necessary to compound that growth over time. Their sales are very flat, as is their operating income. This is a no growth company. They're so saturated in the market in the United States now, there's just not a lot of room left for them to grow. And eventually they're going to have to pay down this debt. So as Verizon's less than stellar balance sheet catches up with it, in my view, they're a big candidate for a dividend cut and thus a dividend trap. Next, I want to look at Walgreens Boots Alliance, ticker WBA. I have been very critical of this business in the past. I use them often as an example in many different ways on what to look out for a poorly run business. And as a dividend trap, it's no different. Walgreens cut their dividend at the beginning of their fiscal year 2024. So it's not reflected in this chart here, but now their dividend is only $1 per share. At the time when their fiscal year 2023 closed, their yield was at 7.6%. Their free cash flow payout ratio was over 1,000%. Their free cash flow has been declining for years. You can see that year-over-year dividend growth slowing right before that dividend cut. All of the signs were there for this business prior to that dividend cut, signaling to the market what a dividend trap this business is. It's a very poorly run business. They made some horrible acquisitions, seemingly year after year, starting in the 2000s. And it all caught up with him after about 2016 when things started to seem to fall off the rails for Walgreens. They're closing stores left and right nationwide. They've gone through quite a few CEOs in the last couple of years. Like I said, their current dividend's at $1 and their current dividend yield is at 11.5%. Their current share price is at $8.71. They have lost 66% on the year. An investment in Walgreens on January 1st, 2024 has already lost 2/3 of its value. We can see their 3-year annualized return is at negative 43.5%. Their 5-year annualized return is at negative 30.8%. And their 10-year annualized return is at a negative 18%. As an investor, 10 years ago today, if you invested in Walgreens, you'd have lost on average 18% of your money each year. And it's not just the dividend cuts they've been suffering. They've lost their status as a Dow Jones Industrial member, one of 30 that make up that index. They were replaced by Amazon, by the way. You can see as the sales have just flattened out after 2016, the earnings slightly declining, some terrible years, COVID year notwithstanding. The cash flow, just a steady decline since about 2016. There's nothing about this business that signals health, that signals please invest. This is, in my view, the ultimate dividend trap. And the last business I want to look at today is AT&T. AT&T is a former dividend aristocrat that had to cut their dividend in fiscal year of 2022. They haven't increased it since then. However, it seems like they're back on track. At least they're turning things around, albeit slowly. You can see up to that dividend cut, that steady rise in the dividend yield, signaling dividend trap status. But since the cut, it has fallen. Now their dividend is currently at $1.11. The yield has come down even further since from that 6.6% to 5.15%. Free cash flow payout, again, coming down now at 39%. And that's going to happen when you cut the dividend. You're going to free up more cash flow to either pay down debt, reinvest back into the business to get growth back on track. And you can see perhaps they are turning around. Since that dividend cut, still a small sample size, but free cash flow per share has increased since 2022. While their sales have definitely declined, it's a slight increase year over year from fiscal year 2023 over fiscal year 2022. And you can see here too, that operating cash slightly increasing. So again, very small sample size. It appears that AT&T has a long way to go, but it seems like management has made some decent decisions. It is starting to turn that massive ship around, and things may be getting better for AT&T. They are up year to date 28% after all. You can see here that they've used that excess free cash flow to pay down some debt. And if we look at the profitability, you can see it's steadily increasing again. So things seem to be back on track for AT&T, or at least heading in the right direction. These are just a few examples of what to look out for dividend traps. Like I said, Whirlpool and Verizon seem to be prime candidates for a dividend cut in the near future. All the signs are there. And if you compare them to what Walgreens was prior to their dividend cut, it looks like the same type of situation. So you don't want to invest in a dividend trap if you're relying on that growth year after year. We're relying on dividends as passive income. And hopefully today I gave you some good, solid red flags to watch out for before investing in those very attractive high yield dividend stocks. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.